You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
Imagine buying a stock for under $9, right? And then like 25 years later, that exact same company is just handing you $8 in pure cash every single year.
Yeah, it's almost hard to wrap your head around, honestly.
Right. I mean, you're getting nearly 100% of your initial investment back annually without even selling a single share. It's wild.
It really is. And, that's exactly what we're getting into today.
Exactly. So welcome to the Technical Intrinsic Value Podcast for today's deep dive. We're stripping down the actual mechanics of dividends today.
Yeah, moving way past the usual Wall Street noise.
For sure. Because the mission here is to build a real actionable playbook for you, especially if you're a novice retail investor who is just, tired of the financial treadmill.
And it's such a vital framework to establish right now. I mean, especially given the current landscape we're in.
Oh, absolutely. The landscape is chaotic.
It is. We constantly see retail investors just inflicting unnecessary pain on their own portfolios. I mean, they're playing a game that institutions designed specifically to extract retail capital.
Yeah, rather than actually using the market as a tool for real defensive wealth accumulation.
Right. And we really need to focus on that friction right out of the gate.
Definitely. Because if you look at the culture of retail investing today, it's entirely built around this high-stress, hyperactive trading mentality.
Oh, yeah. It's exhausting just watching it.
It really is. It's people trying to trade zero-day options or, chasing momentum in meme stocks or trying to day trade their way to financial independence.
Which is, statistically speaking, just a completely losing battle.
Yeah, it's an environment of extreme anxiety. Your success completely depends on perfect timing and just staring at a screen all day.
Right. And the vast majority of active retail traders, they just underperform the broader market. A huge percentage actually lose their entire capital base over a 5-year horizon.
Which is devastating.
It really is. This hyperactive trading culture is basically the absolute antithesis of defensive capital allocation.
So let's define that. Defensive allocation isn't just about being scared, right?
No, not at all. It is not synonymous with being fearful or overly conservative. It's actually a highly calculated posture.
Right. It's about playing smart.
Exactly. It's the recognition that preserving your capital base and prioritizing structurally sound mathematical returns over these speculative, low-probability trades that's the only proven path to generational wealth.
So we're essentially shifting the paradigm for you from, how much can I make today to how indestructible is my income stream for the next decade?
Spot on. And to do that, we have to look at the market through a very specific, uncompromising lens.
Which brings us to the core philosophy here. I want to make it super clear that all the analysis we're unpacking today reflects the distinct views of Nicolau Primavera Carvalho.
Right, the author and creator of the Technical Intrinsic Value Model, or the TIV model.
Yeah, the TIV model. And what's really fascinating about his philosophy is its absolute reliance on structural data.
Exactly. It completely removes the guesswork.
Right. It is engineered to aggressively filter out all that subjective bias and emotional noise that usually dictates how retail investors behave.
Because, let's face it, human psychology is just inherently flawed when it comes to capital markets.
Oh, 100%. We are not wired for this.
No, we really aren't. Our evolutionary biology wires us to flee from pain and chase immediate gratification.
Which is terrible for investing.
The worst. In the market, that translates to panic selling at the absolute bottom of a cycle and then aggressively buying at the euphoric top because of FOMO.
Yeah, the fear of missing out is real.
Yeah.
So the TIV model kind of acts as this objective mathematical anchor, right?
Yes, exactly. It relies entirely on the structural geometry of the market and the underlying fundamental health of the asset to dictate action.
So it basically tells you when an asset is cyclically primed and fundamentally undervalued.
Right, completely neutralizing the urge to just act on fear or whatever the media hype of the day is.
A really great way for you to conceptualize this shift is by comparing it to real estate.
Oh, I love this analogy.
Yeah, so most retail investors treat the stock market like flipping houses, right? They try to find a distressed property or a volatile stock, buy it, and endure massive stress hoping it appreciates.
Yeah, just praying they can offload it to the next buyer for a quick profit.
Exactly. It's a high-risk, high-stress endeavor. But defensive dividend investing, it's way more like passive rental income.
Right, because when you own a rental property, you don't obsessively check its market value every single morning.
No, of course not. You care about the tenant paying the rent on the first of the month.
Exactly. So in our framework, the underlying stock price is just the value of the house.
But the dividend, that is the unbreakable rent check arriving in your account, regardless of what the housing market is doing that day.
That analogy perfectly isolates the goal here. It's about transitioning your psychological dependency away from unpredictable capital appreciation and anchoring it to highly predictable cash flow.
Right. But to actually operate effectively as a landlord in the equity markets, you really have to intimately understand the foundational mechanics.
Yeah, you need to know how this capital is actually distributed.
So let's do a rapid high-level audit of those mechanics. We know you are likely past the absolute beginner stage, so
Yeah.
we won't linger too long, but there is a very specific sequence to how a dividend is processed.
And it's crucial, because if you get the timeline wrong, you simply do not get paid.
Okay, so walk us through it. What's the sequence?
Well, there are basically 4 chronological milestones. The sequence kicks off with the declaration date.
Okay, so that's just the announcement.
Right. It's the formal announcement by the corporate board establishing the size of the dividend and setting the timeline.
Got it. And then what's next?
Next is the most operationally critical moment for you as an investor, the ex-dividend date.
This is the big one.
It is the absolute hard cutoff. To legally claim that upcoming dividend, you must execute your purchase prior to the ex-dividend date.
So if I buy it on the actual ex-dividend date, I'm too late.
Exactly. Purchasing on or after that date means the dividend goes to the seller, not you.
Okay, so the ex-dividend date is essentially the barrier to entry for that specific cash flow cycle.
Correct. Now, the third milestone is the record date, which typically follows just 1 business day after the ex-dividend date.
And this is more of a back-end thing, right?
Yeah, it's merely an administrative audit. It's where the corporation finalizes the ledger of eligible shareholders.
So because trades take time to settle, buying before the ex-dividend date just ensures your name is actually on that ledger by the record date.
Precisely. And then finally, we arrive at the payment date.
Payday.
Exactly. The actual distribution of cash into the brokerage accounts of the recorded shareholders.
Okay, so honestly, the mechanics are incredibly straightforward. It's just a simple administrative sequence.
Extremely simple.
But if the sequence is that simple, why is the failure rate so high? Like, why do retail investors consistently erode their capital even when they know the calendar?
Because comprehending the administrative sequence is entirely irrelevant if you can't govern your own behavioral impulses.
Wow, yeah.
I mean, the mechanical execution is maybe 10% of the equation. The remaining 90% is mastering self-regulation.
That makes a lot of sense. So where do people trip up?
We consistently observe retail investors falling into 2 devastating emotional traps.
Okay, what's the first one?
The aggressive pursuit of euphoric hype during late-stage bull markets, basically chasing shiny objects when everyone is greedy.
Right. And the second?
Capitulation, panic selling during volatile macroeconomic drawdowns.
Yeah, we have all felt that pressure, right? The market experiences a localized correction, dropping, 5 or 8% in a matter of days.
And it feels like the end of the world.
Totally. The financial media immediately amplifies the narrative of a looming recession, and the retail investor sitting there watching their paper wealth evaporate feels this overwhelming psychological compulsion to just liquidate everything.
Just to stop the pain.
Exactly. Just sell it all to make the anxiety go away.
Which brings us to the core utility of building what we call an emotional firewall.
I love that term, emotional firewall.
Yeah, because when we say self-regulation is half the battle for achieving long-term investment success, we are talking about engineering a portfolio that physically protects you from yourself.
So how do you actually build that?
By anchoring your strategy to reliable dividend income and governing your entries through the strict data rules of the TIV model, you construct a psychological barrier against that panic.
Okay, let's break down the actual mechanism of that firewall.
Yeah.
How does receiving, say, a 3% cash yield physically stop you from hitting the sell button when your portfolio is down 20%?
Well, it changes the fundamental utility of the portfolio in your mind.
How so?
Think about it. When your entire strategy relies purely on capital appreciation, a 20% drawdown means your portfolio has failed its primary objective.
Right, the number went down, so I'm losing.
Exactly. The psychological pain is acute. However, when you hold high-quality dividend-paying assets, a market crash only affects the paper value of the shares.
But the cash is still flowing.
Yes, the cash flow, the rent checks, continues to hit the account. The asset is still performing its primary function of generating capital.
I see. So it kind of acts as a tranquilizer.
That's exactly what it is. It proves to you that the underlying business is still solvent and functioning. And that provides the emotional discipline required to hold the asset through the bottom of the cycle instead of liquidating at a massive loss.
So building an emotional firewall keeps investors disciplined during volatile periods. That's powerful.
It's essential.
But let me challenge this against the conventional wisdom of Wall Street, right? Because the standard advice broadcast to retail investors is simply to buy a broad index fund and hold it blindly for 4 decades.
Yes. Total stoicism.
Right. So how does the technical intrinsic value approach fundamentally differ from that traditional buy and hold mandate?
Well, the fatal flaw in traditional buy and hold evangelism is that it demands a level of emotional endurance that 99% of human beings simply do not possess.
That's a great point. It's easy to say, just hold, but it's hard to do.
Very hard. Traditional strategies require you to blindly hold an asset while it endures a 40, 50, or sometimes 60% drawdown.
Just operating on the hope that it'll recover?
Exactly. Operating on the mere hope that it will eventually recover its previous high over the next decade. And, I mean, that is an excruciating way to deploy capital.
And often, they don't recover. Or, they take 15 years just to break even, which represents a massive opportunity cost.
Precisely. The TIV approach rejects blind stoicism. Instead, it emphasizes maintaining emotional discipline through rigorous TIV cycle analysis.
Okay, so you're holding with a purpose.
Right. You are not holding an asset simply because of passive dogma. You are holding it because its long-term technical structure remains intact and it's aligned with its intrinsic fundamental value.
So it's about context.
Yes. The TID framework is designed to prevent you from buying at the exhausted peak of a cycle in the first place, thereby mitigating those catastrophic 50% drawdowns before they even occur. It beautifully blends fundamental solvency with technical timing.
That distinction is so critical. We are not just holding blindly. We are holding with structural context.
Exactly.
So let's pivot to auditing the fundamental solvency of these companies, because there's a very specific trap that novice dividend investors fall into.
Oh, the yield trap.
Yes. They open a screening tool, filter the entire market by the highest dividend yield percentage, see a company offering a massive double-digit return, and they aggressively buy it.
And it is one of the most efficient destroyers of retail wealth in the equity markets.
But let me play devil's advocate here.
Yeah.
If I'm looking at 2 companies in the same sector, right? Company A is offering a stable 3% yield, while Company B is offering a massive 15% yield.
I know where you're going with this.
Mathematically, taking the 15% seems like the superior play. If they are offering to pay it, why shouldn't I just grab that outsized cash flow?
Because that 15% is almost certainly an optical illusion.
An illusion. How?
It's masking a collapsing business.
Right.
You have to understand the mathematical formula for dividend yield. It is the annualized dividend payout divided by the current share price.
Right. Payout over price.
Therefore, when you see a skyrocketing double-digit yield, it is rarely a signal of incredible corporate generosity or massive profitability.
What is it?
It almost universally indicates that the denominator of the stock price has completely cratered.
Oh, because institutional money is bailing out.
Exactly. They've detected severe fundamental distress and are abandoning the asset en masse.
So the high yield is essentially a distress beacon.
That's a perfect way to put it. The yield only looks that high because the stock price has been cut in half, or worse.
Contrast that with sustainable dividend growth, right?
Oh, yeah.
Chasing those high yields is just a dangerous habit.
Incredibly dangerous. The company is likely operating at a severe deficit, and that dividend is being funded by liquidating assets or taking on toxic debt, not from actual operating profits.
So it's a house of cards.
Entirely unsustainable. Within a matter of quarters, the board will be forced to cut or suspend the dividend entirely.
And what happens then?
When that announcement hits the wire, the stock price will crash a second time, leaving the retail investor with absolutely no income and a massive capital loss.
Brutal. So how do we avoid this?
To navigate away from these traps, the TIV framework requires a rigorous audit of the company's internal plumbing. And the absolute paramount metric for that audit is free cash flow.
Okay, let's really dissect free cash flow versus net income. Because if you turn on the TV or read standard financial news, the absolute obsession is net income or earnings per share.
Yes, it's all they talk about.
Every quarterly earnings call revolves around whether a company beat its earnings per share estimate. If Wall Street is so hyper-focused on net income, why is Nicolaus' TIV model discarding it in favor of free cash flow?
Well, because net income is an accounting construct.
Meaning it's not real cash.
Right. And accounting constructs can be legally manipulated to present a narrative that diverges wildly from reality.
Give me an example of how they manipulate it.
So net income includes numerous non-cash variables and accrual accounting assumptions. A company can recognize revenue for products they have shipped, but haven't actually received a single dollar of payment for yet.
Wait, really? So they can claim the profit before getting paid?
Yes. Or they factor in massive deductions for the depreciation of their equipment or the amortization of intangible assets.
Well, it gets muddy fast.
Very muddy. A company can report a highly profitable net income on their income statement while simultaneously having a corporate bank account that is dangerously close to zero.
Wow. So net income is a theoretical number based on accounting rules, whereas free cash flow is the unforgiving reality of the corporate checking account.
That is the crucial distinction right there. You cannot pay a dividend with accounting adjustments. You cannot pay a dividend with amortized goodwill.
Right, you need cash.
You can only pay a cash dividend with actual unencumbered cash. That is why analyzing why free cash flow is superior to net income for checking dividend safety is just a foundational principle.
Okay, so what exactly is free cash flow measuring then?
Free cash flow measures the exact amount of hard currency the business generated from its core operations, strictly after it has paid for all necessary capital expenditures.
So like the physical cash required to maintain its real estate or upgrade its servers or repair its machinery.
Exactly. The money left over to actually hand back to you.
We want the hard cash left over after all the bills are paid and the business is secured. So how do we apply this metric practically when looking at a stock?
We look at the free cash flow payout ratio. We need to determine exactly what percentage of that remaining hard cash is actually being distributed to shareholders.
Let's use a real example.
Sure. Let's examine a structurally sound example in the current 2026 environment. Automatic data processing, ticker ADP.
ADP, got it.
ADP currently operates with a highly conservative FCF payout ratio of approximately 56.68%.
Okay, so let me translate that. That means for every dollar of free cash they successfully pull out of their operations, they distribute roughly 57 cents to the shareholders and retain 43 cents.
Correct. And that 43 cents, that represents a massive margin of safety.
It's their buffer.
Exactly. It acts as an internal corporate shock absorber. If the broader economy enters a deep recession and ADP's revenues temporarily contract, well, they have a massive buffer of retained cash.
So they wouldn't have to cut the dividend immediately.
Right. They can easily maintain or even continue to grow the dividend without having to borrow money or compromise their core business operations.
That makes perfect sense. Now, another critical metric emphasized in the TIV framework for auditing corporate plumbing is the interest coverage ratio, or ICR.
Yes, ICR is vital right now.
Because we are operating in a vastly different macroeconomic reality in 2026 than we were 5 years ago. How should you utilize the interest coverage ratio to avoid dividend traps in this specific environment?
It requires a real acknowledgement of the current cost of capital. We have definitively exited the zero interest rate policy era.
Those days are long gone.
Long gone. The Federal Reserve's target range has stabilized at a higher plateau of roughly 3.00 to 3.25%.
Which changes everything for corporate debt.
It fundamentally changes corporate solvency. Debt is no longer virtually free. Companies that aggressively leveraged their balance sheets with cheap debt a few years ago are now facing aggressive refinancing cliffs at significantly higher rates.
Their interest expense is just exploding.
Exploding. So the ICR is our tool to see if the company is drowning in that new interest expense.
Okay, so how is it calculated?
The interest coverage ratio measures how many times over a company can pay its current interest obligations using its operating profits, specifically earnings before interest and taxes, or EBIT.
And what's the warning sign?
If a company's ICR drops below 1.5x, the TIV model flags it as entering a severe distress zone.
Hold on. Let me just think about that. A 1.5x ratio means they are making 50% more operating profit than their interest bill.
Right.
Why is that considered a severe distress zone? It sounds like they still have a buffer.
Because operating profit is not static. If a company is operating at a 1.5x ratio during a normal, healthy economic period, their margin for error is razor thin.
I see.
If a mild recession hits and their operating profit contracts by mere 30%, they suddenly drop below 1.0x.
Meaning they are mathematically incapable of servicing their debt from their operations.
Exactly. And when that happens, the first thing the board of directors will do to avoid defaulting on their loans and triggering bankruptcy is eliminate the dividend.
The dividend is always the first casualty of debt distress.
Always. So we need a much wider moat.
What does a fortress balance sheet look like through the lens of the ICR? Give me a good example.
Look at S&P Global, ticker SPGI.
Okay.
In 2026, they are demonstrating an interest coverage ratio of 22.8x.
Whoa! They can pay their annualized interest obligations almost 23 times over with their operating profit.
Yes, that is absolute balance sheet supremacy.
That's insane.
Right. Even if S&P Global suffered a catastrophic, historically unprecedented 70% collapse in operating profit, they could still easily service their debt without ever threatening the dividend distribution.
That is how you utilize hard data to audit the plumbing and decisively neutralize the threat of yield traps.
Exactly.
So we've established the defensive perimeter. We know how to ensure the dividend is safe by auditing free cash flow and the interest coverage ratio.
Right. The plumbing is sound.
But defense alone doesn't build generational wealth. We have to discuss growth, specifically how these companies engineer value behind the scenes.
Which leads us to the concept of the compounding engine and total shareholder yield.
Yes. Let's get into this because this is where we transition from merely preserving capital to structurally multiplying it.
Right, because evaluating a company solely on its stated dividend yield provides an incomplete and honestly often misleading picture.
So discussing how total shareholder yield provides a clearer picture of investment success is paramount.
It is. Total shareholder yield, or TSY, aggregates the standard dividend yield with the share buyback yield.
Okay, let's pause on the share buyback yield because it's often misunderstood by retail investors.
Yeah, it happens entirely behind the scenes.
Right. You don't see a cash deposit in your account for a buyback. Can you explain the actual physics of how a buyback enriches you?
Of course. When a corporation generates excess free cash flow, it essentially has two primary mechanisms to return that capital to you.
Okay, the dividend is one.
Right, it can distribute it directly as a cash dividend, or it can deploy that cash into the open market, purchase its own outstanding shares, and permanently retire them.
Destroying them, basically.
Yes. By executing a share buyback, the company is systematically reducing the total supply of shares in existence.
So let's make this tangible. If a company has 100 total shares outstanding and I own 10 of them, I own exactly 10% of that underlying business.
Correct.
If the management team takes corporate cash, buys back 20 shares from the open market, and destroys them, there are only 80 shares left.
Exactly.
I still own my 10 shares, but my ownership stake has organically grown from 10% to 12.5%.
Precisely. Without you having to execute a trade, pay a commission, or invest a single additional dollar, your fractional ownership of the entire enterprise just expanded.
That's incredible.
It is. It means your claim on all future earnings and your share of all future dividend distributions increases proportionally.
But there's another angle to this, right? The taxes.
Yes, the most powerful aspect of the share buyback is its immense tax efficiency.
Because with a cash dividend, the IRS is waiting with their hand out immediately.
Correct. In most jurisdictions, a cash dividend triggers an immediate taxable event in the year it is received. It is a drag on your compounding velocity.
But a buyback avoids that.
Yes. A share buyback invisibly inflates the intrinsic value of your remaining shares. You experience capital appreciation, but you do not owe a single cent in capital gains tax until you voluntarily decide to sell the asset years or decades later.
So it is a mechanism for frictionless, untaxed compounding.
Exactly.
But let me introduce some friction here. Aren't buybacks heavily criticized for being a tool of corporate manipulation?
Oh, absolutely, and often rightly so.
Because we frequently hear about executive boards borrowing massive amounts of cheap debt to buy back stock purely to artificially inflate their earnings per share.
Right, just to trigger their own executive bonus packages while simultaneously weakening the balance sheet.
Yeah, that seems highly problematic.
That is a highly valid criticism, and it highlights exactly why the TIV model demands an audit of the cash flow statement first.
Oh, so the audits protect us here too?
Yes. Buybacks are only beneficial if they are funded by organically generated free cash flow.
So if a company is issuing billions in corporate bonds, taking on massive debt specifically to fund share buybacks.
It is financial engineering of the worst kind. They are destroying the long-term solvency of the company for short-term optical gains.
Got it. So we only calculate total shareholder yield for companies that already passed the initial free cash flow and ICR audits.
Exactly. If the buyback isn't funded by free cash, it is a liability, not an asset.
Okay, so assuming the buybacks were funded cleanly from cash flow, we want a company that pays a healthy dividend and consistently reduces its share count.
Right.
How do we practically screen for this? What is a quick mathematical heuristic you could use to identify these compounding machines?
We utilize a highly effective heuristic known as the Chowder Rule.
The Chowder Rule.
Yes. Walking listeners through the Chowder Rule is really the most direct way to identify quality dividend growth stocks. The rule elegantly balances current income with future compounding potential.
So how is it calculated? Walk me through the math.
You take the company's current dividend yield percentage and you simply add its 5-year dividend growth rate, or DGR.
Okay, but why specifically the 5-year average? Why not just use last year's dividend increase?
Because a single year can be an anomaly. A company might have a massive windfall year and hike the dividend by 20%, or they might have a difficult year and only hike it by 1%.
Right, so it skews the perspective.
Exactly. The 5-year dividend growth rate smooths out those macroeconomic fluctuations. It provides a much more accurate reflection of management's long-term commitment to shareholder returns and the underlying consistency of the business model.
Okay, so we take the current yield, add the 5-year growth rate, and we get a number. What is the passing grade?
For standard equities and growth-oriented businesses, the TIV quality threshold requires a minimum Chowder score of 12.
12, okay.
If you are analyzing sectors that inherently operate with lower growth but much higher initial yields, such as utilities or real estate investment trusts, known as REITs, the passing threshold is adjusted down to 8.
Let's run this through some real-world 2026 data to see how it filters the market.
Great idea. Let's return to our benchmark, ADP.
Okay, ADP.
Currently, ADP is offering a starting dividend yield of 3.21%. However, their 5-year dividend growth rate is a highly aggressive 12.171%.
So 3.21 plus 12.17 gives us a total Chowder score of 15.38.
Exactly. It shatters the minimum threshold of 12. It represents an elite balance of immediate income and aggressive compounding.
Wow, okay. Let's get another one.
Now let's contrast that with Lowe's, ticker LOW.
The home improvement retailer.
Right. Their current yield sits at 2.01% and their 5-year growth rate is 9.86%.
So that yields a score of 11.87.
Which narrowly fails the threshold of 12. It indicates that while the company is healthy, the combination of entry yield and historic growth velocity is not currently optimal for maximizing the compounding engine under the TIV framework.
It's close, but no cigar. What about a massive company, like a consumer staple?
Let's analyze PepsiCo, ticker PP.
Perfect.
Their current yield is a very attractive 3.59%. However, their massive size has constrained their 5-year growth rate, which has decelerated to 6.02%.
So 3.59 plus 6.02 equals 9.61. That's a definitive failure for a standard equity.
Yes. The high initial yield is a siren song masking the reality that the compounding velocity has severely stagnated. The Chowder Rule prevents you from being seduced by a high starting yield when the long-term growth mechanics are broken.
But this introduces a massive psychological conflict for retail investors.
How so?
Because a company like PepsiCo is universally celebrated as a dividend aristocrat. I mean, it has increased its dividend payout every single year for over 50 consecutive years.
Yes, it has.
The prevailing narrative is that a 50-year track record makes an aristocrat an automatic, unquestionable investment. How does the TIV framework view this?
With extreme skepticism, honestly.
Really? Why?
This is what we define as the aristocrat trap. A 50-year track record is an impressive historical artifact, but past performance is utterly irrelevant to future solvency.
That's a harsh reality check.
It is. Retail investors often treat aristocrats as invincible institutions, blinding themselves to what we call the innovation gap.
What is the innovation gap?
It occurs when a legacy company operates within an industry that is structurally declining or facing massive technological disruption. Their core underlying business is actually eroding.
But they keep raising the dividend anyway.
Yes. The executive board is terrified of losing their prestigious aristocrat status.
Because of the optics.
and the capital flow. They know that if they fail to increase the dividend, massive institutional index funds and ETFs that mechanically track aristocrats will be forced to liquidate their positions.
Oh, which would cause the stock price to just collapse.
Exactly. So the title of aristocrat essentially holds a gun to the head of the management team.
Wow. So to maintain the illusion of growth, they engage in highly destructive behavior.
Precisely. They will slash their internal research and development budgets, effectively sacrificing the future of the company.
Just to keep the dividend streak alive.
Or worse, they will issue corporate debt specifically to fund a microscopic 1 penny per share increase to the annual dividend, purely to keep the aristocrat title alive for one more year.
They are essentially a zombie corporation. They are slowly liquidating their own future just to maintain an optical streak for institutional algorithms.
That is the perfect description. The dividend is technically growing, but the structural integrity of the business is collapsing underneath it.
That's terrifying.
This is exactly why you must ruthlessly apply the TIV plumbing audits. You cannot blindly trust a historical title.
Right. If a company is an aristocrat, but its free cash flow payout ratio is at 95%, and its interest coverage ratio is deteriorating.
You are looking at a trap, not an investment.
Okay, so let's shift from the traps to the triumphs. Let's examine the mathematics when you successfully navigate the plumbing, utilize the chowder rule, avoid the zombies, and lock into a true compounding machine.
This is the fun part.
Let's talk about real returns, because this introduces the concept of yield on cost. This completely recontextualizes how we view portfolio income.
Yield on cost, or YOC, is the ultimate metric of success for the defensive capital allocator.
It fundamentally separates the long-term investor from the short-term trader.
Entirely. When you log into your brokerage platform, the interface always displays the current dividend yield, which is continuously calculated against today's fluctuating market price.
But yield on cost is different.
Very different.
Yeah.
Yield on cost anchors your return to reality. It measures the dividend yield specifically against the original capital you deployed to acquire the asset.
Let's ground this with a simplified mechanical example before we get into the real data.
Sure.
So if I purchased a stock 10 years ago for $50 a share and it pays a $2 annual dividend, my initial yield on that day is 4%.
Correct. $50 in, $2 out, 4%.
But assuming it is a high-quality compounder, the business grows over the next decade. The stock price appreciates to $200 a share, and management aggressively hikes the dividend payout every year. Today, the company distributes $8 per share.
Right.
So if a new investor looks at the stock today, they see a price of $200 and a dividend of $8. The yield is exactly 4%. To the broader market, nothing has changed. The yield looks identical to when I bought it 10 years ago.
But your internal reality is vastly different.
Because my cost basis hasn't changed.
Exactly. You are receiving that exact same $8 dividend, but you only ever risked $50 of capital to get it.
So my personal yield on cost is now 16%.
Yes. You are generating a 16% unencumbered cash return on your original investment every 12 months, regardless of what the stock price does tomorrow or next week.
It is the financial equivalent of planting a seed and eventually harvesting the entire tree every single year.
It really is.
But I have to challenge this with the most destructive force in economics: inflation.
Ah, yes. The invisible tax.
A 16% return sounds incredible in a vacuum. But if the cost of housing, energy, and groceries has doubled over that same 10-year period, that 16% is buying significantly less real-world utility.
That's the sad reality.
So are we actually building wealth, or are we just generating bigger numbers on a screen that buy fewer goods?
That is the most critical question an investor can pose. Discussing why calculating real returns helps combat purchasing power erosion over time is really the ultimate stress test of the TIV methodology.
So how do we prove it?
To prove how defensive capital allocation actively defeats inflation, we need to analyze a highly specific historical case study. We are going to look at United Healthcare, ticker UNH.
Okay, let's dig into the UNH data.
We will start with a recent execution. Nicolau Primavera Carvalho, utilizing the TIV cycle analysis, identified a high probability entry point for UNH.
And when was this?
He acquired the asset at $319.99 on May 14, 2025.
Okay, $319.99 in May 2025.
Today, as we sit here on May 2, 2026, the company is trading at $368.78. And the dividend yield relative to his 2025 cost basis was established at a highly secure 2.64%.
So within roughly a year, The TIV model successfully captured solid capital appreciation while locking in a structurally safe initial yield. It is a textbook short-term validation.
It is, but to truly comprehend the inflation-crushing power of yield on cost, we must extrapolate this much further back.
Okay, how far back?
We need to look at the historical compounding velocity of United Healthcare. Let's analyze the position of an investor who understood these defensive principles and acquired UNH decades ago, specifically in July of 1999.
Wow. Taking us way back to the dot-com bubble era.
Exactly. In July 1999, adjusting for subsequent stock splits, a share of United Healthcare could be acquired for exactly $8.72.
$8.72, got it.
Now, we advance the timeline 25 years to the end of 2024.
Okay.
For the full year of 2024, United Healthcare distributed $8.18 in total dividends per share.
Wait, let me make sure I am grasping the sheer scale of those numbers.
It's staggering.
You deployed $8.72 of total capital in 1999. And 25 years later, the company handed you $8.18 in cash in a single year without you ever having to sell the asset.
Yes. Mathematically, that represents a nominal yield on cost of 93.8%.
Almost 100%.
You are essentially having your entire initial capital investment reimbursed in cash every 12 months.
That's just wild.
And consider the psychological fortitude required to achieve that. That investor had to hold that asset through the 2000 tech crash, the devastating 2008 global financial crisis, the 2020 pandemic volatility, and the 2022 rate hike shocks.
Yeah, they only survived those terrifying drawdowns because their emotional firewall, that ever-growing stream of dividend cash, kept them anchored.
Anchored to the fundamental reality of the business rather than the manic swings of the stock price.
Okay, the nominal return is staggering, almost 94% annually. But we still haven't addressed the inflation reality.
Right, because $8 in 1999 had significantly more purchasing power than $8 today.
Exactly. So how do we adjust for that?
This is why we mandate adding a section explaining the inflation-adjusted yield on cost formula. We must discount the original investment by the historical inflation rate to find our true economic return.
So we have to translate that 1999 capital into 2024 purchasing power.
Right. Utilizing the cumulative consumer price index data over that 25-year period, that original cost basis of $8.72 from 1999 is equivalent to $17.12 in modern inflated dollars.
Okay, so we have leveled the playing field. The cost basis, adjusted for the erosion of the dollar, is $17.12.
Correct. Now we calculate the real return. We take the 2024 dividend distribution of $8.18 and we divide it by the inflation-adjusted cost basis of $17.12.
And the result?
The final result is a real yield on cost of 47.8%.
A real yield on cost of 47.8%. That completely changes the narrative.
It does, doesn't it?
Even after factoring in 25 years of aggressive macroeconomic inflation designed to destroy your purchasing power, this single defensive asset is returning nearly half of your true inflation-adjusted wealth back to you in unencumbered cash every single year.
That is the entire objective of defensive capital allocation.
It's beautiful.
You identify fundamentally pristine businesses, you acquire them at technically sound valuations, and you allow the internal compounding engine to vastly outpace the rate of macroeconomic inflation.
You are not just preserving wealth, you are structurally expanding your purchasing power across decades.
Exactly.
The UNH data absolutely validates everything we have discussed regarding the fundamental plumbing and the compounding engine.
Yeah.
But the final piece of the puzzle, the element that makes the TIV framework uniquely powerful, is timing.
Yes, timing is where everything crystallizes.
Because finding a fundamentally sound company like UNH is only half the equation. As you mentioned earlier, if you buy a great company at the absolute peak of a euphoric market cycle, you can still suffer a massive decade-long loss.
Absolutely. You can be right on the business and wrong on the entry.
We need to explore how TIV cycle analysis actually identifies these precise entry points. Let's incorporate a practical, real-time example.
Incorporating the CBU case study as a practical example of a long-term compounder perfectly illustrates the intersection of fundamental safety and cycle geometry.
Okay, let's hear it.
We are looking at another recent execution by Niccolo Primavera Carvalho involving Community Bank System, ticker CBU.
Community Bank System, a regional banking institution. On the surface, that sounds incredibly mundane compared to the high-flying tech stocks retail investors usually chase.
But mundane predictability is the foundational bedrock of reliable compounding.
Fair point.
CBU is a highly diversified, conservatively managed regional financial institution. Crucially, It is an elite dividend aristocrat with over 30 consecutive years of dividend growth.
And I'm assuming it passes the audits.
With flying colors. Its free cash flow generation and interest coverage metrics are immaculate. The fundamental plumbing is pristine.
But again, under the TIV philosophy, a pristine business is only a viable investment if the market geometry aligns.
Right. So how did the TIV model process the geometry for CBU?
Yeah, what were the exact data points that triggered the execution?
The proprietary algorithms within the TIV model monitor long-term technical structures. In February of 2025, the model signaled a critical intrinsic value price level for CBU at exactly $66.89.
Okay, $66.89.
This signal was a mathematical indication that the multi-year technical downtrend had exhausted itself, and the stock price was finally reverting to align with the underlying intrinsic value of the bank's cash flows.
So the system flashes a buy signal at $66.89, but Niccolo didn't execute the trade at that exact moment, did he?
No, and this illustrates the discipline of the framework perfectly.
How so?
Emphasizing maintaining emotional discipline through TID cycle analysis means you do not blindly chase initial signals. The market moves in wave structures, breathing in and out.
So he waited.
Carvalho waited for the inevitable natural macroeconomic pullback. Over the next several months, the broader market experienced localized volatility, and CBU drifted downward into a state of deep technical undervaluation.
And then?
Finally, on September 8, 2025, the geometric structure optimized, and Carvalho executed the purchase at $59.62.
Wow. He utilized the TIV framework to secure an entry point more than 10% below the initial structural signal, massively increasing his margin of safety.
Precisely. And let's review the outcome. Today, May 2, 2026, CBU is trading at $63.62.
So he's already up on the capital side.
Yes. But more importantly, his entry point at $59.62 locked in a highly secure 2025 dividend yield of 3.24%.
He captured immediate capital stabilization while securing a 3.24% yield from an elite aristocrat. But what makes that specific execution at $59.62 so structurally significant?
Because the TIV cycle analysis confirmed that CBU is establishing what we defined as wave one of a new multi-year bullish structure.
Break that down geometrically for the listener. What physically constitutes a wave one on a chart, and why is it the holy grail for a defensive investor?
Geometrically, a market cycle consists of distribution phases where prices collapse and accumulation phases. A wave one structure occurs at the absolute conclusion of a prolonged, devastating bear market.
When everyone else has given up.
Exactly. The asset has been heavily sold off, the weak hands have capitulated, and the price structure begins to carve out a massive rounded base.
Okay.
Wave one is triggered when the asset finally breaks the geometric sequence of lower highs and lower lows and definitively establishes its first macro higher lows.
It represents the exact moment institutional capital begins quietly accumulating the asset, reversing the structural momentum.
Yes. By utilizing the TIV model to execute an entry specifically within Wave 1, you are positioning your capital at the absolute genesis of a new multi-year upward cycle,
while simultaneously anchoring it to a structurally flawless dividend.
It is the ultimate synthesis.
You are securing the impenetrable fundamental safety of an aristocrat's cash flow, while mathematically neutralizing the downside risk by entering at the geometric floor of the cycle.
That's the magic of it.
If you are listening to this right now and realizing that you have been navigating the markets completely blind to this layer of structural geometry and fundamental auditing, you really need to recalibrate your entire approach.
Without a doubt.
You must secure a copy of Niccolo Primavera Carvalho's book, Technical Intrinsic Value, which is available right now on Amazon.
I can't recommend it enough.
Do not forget to make it the foundation of your ongoing education. It completely decodes the architecture of these market cycles.
The book is the essential starting point for neutralizing your emotional biases. However, for those individuals who recognize the absolute necessity of mastering this framework and want to elevate their execution to an institutional standard, I strongly advise looking into the Technical Intrinsic Value program.
Tell us about the structure of the program, because I know it operates very differently from typical financial courses out there.
It is entirely different. It is a highly exclusive, intensely focused, high-integrity mentorship.
Okay, what makes it so exclusive?
The defining characteristic of the program is that it is strictly limited to a maximum of 5 students at any given time.
Wait, only 5 students globally?
Yes.
That is an incredibly aggressive bottleneck. Why cap it so low?
Because the objective is not mass distribution, the objective is absolute top-to-bottom mastery of the TIV model.
You want quality over quantity.
Exactly. We are fundamentally rewiring how an individual perceives capital allocation, cycle geometry, and the calculation of intrinsic value.
And you just can't do that in a big group.
You cannot achieve that level of deep psychological and analytical restructuring in a massive impersonal lecture format. It requires dedicated, granular mentorship.
Makes total sense.
If you are committed to abandoning the chaotic guesswork of retail trading and want to operate with surgical, data-driven precision, you need to join the waiting list immediately at www.technicalintrinsicvalue.com.
That URL, again, is www.technicalintrinsicvalue.com. With a hard cap of only 5 students, that waiting list is where you need to be if you are serious about defensive allocation.
Absolutely.
Let's synthesize the immense amount of ground we have covered in this deep dive. We started by completely reframing the utility of the equity markets, abandoning the anxiety-ridden model of flipping volatile stocks.
Right, and embracing the mathematically sound architecture of the passive rental income model.
We detailed the administrative mechanics of dividend distribution, but immediately pivoted to the psychological reality.
Explaining why self-regulation is half the battle for achieving long-term investment success.
And how engineering a portfolio of reliable cash flows builds the emotional firewall necessary to survive macroeconomic volatility.
Then we ruthlessly audited the corporate plumbing. We exposed the devastating reality of the yield trap.
We broke down mechanism by mechanism why free cash flow is the only reliable metric for dividend safety compared to the accounting illusions of net income.
We also established the new 2026 reality of higher interest rates.
And how an interest coverage ratio above 1.5x, ideally much higher, like SPGI's 22.8x, is mandatory for survival.
We then explored the mechanics of compounding, demonstrating how total shareholder yield combining dividends with cash-funded share buybacks invisibly accelerates your ownership stake.
We provided the Chowder Rule as a practical heuristic and exposed the zombie corporations hiding within the aristocrat trap.
We proved the inflation-crushing supremacy of real returns with the United Healthcare case study, demonstrating a staggering 47.8% real yield on cost.
And we concluded by mapping the geometry of the market, using the community bank system execution to show how identifying a wave 1 cycle structure perfects the timing of a fundamentally flawless asset.
It really is the complete integration of intrinsic fundamental value and structural market timing.
So to close out this deep dive, I want you to address the frustrated intermediate investor listening right now. They have read the standard advice, they have absorbed the losses of the recent bear markets, and they are seeking a permanent, elevated perspective on how to view their portfolio.
Okay.
What is the final analytical thought on market geometry we can leave them with?
I would impart this core realization regarding the architecture of your capital. Dividends, backed by unmanipulated free cash flow and a fortress interest coverage ratio, provide the indestructible foundational floor of your portfolio's income.
Right.
But the geometric market cycle dictates the ultimate ceiling of your capital.
Oh.
You can identify the most fundamentally pristine dividend in the global market, but if your lack of structural awareness causes you to buy that asset at the euphoric, exhausted peak of a technical cycle.
Game over anyway.
It is the equivalent of placing a perfectly tuned, flawless engine into a vehicle that is actively driving down the wrong side of the highway.
That's a powerful image.
The internal mechanics are perfect, but the external environment will inevitably destroy you. You must align the fundamental floor with the geometric timing.
The ultimate synthesis.
Master the geometry of the cycle and you master the market.
A perfectly tuned engine driving down the wrong side of the highway. That geometric alignment is everything. Thank you for joining us on the Technical Intrinsic Value podcast for this deep dive. Take these frameworks, demand hard data from your assets, build your emotional firewall, and redefine your approach to generational wealth. We will see you next time.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic exploitation to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value model Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.